Let's continue with advanced financial management, risk adjusted discount rate. This is Mr. William, Fatima Institute. Remember to subscribe to our video. And in case you have any question or you need any assistance, my numbers are 0727 We now take risk adjusted discount rate. Under this method, the cost of capital, which is considered to be risk-free, is adjusted with some element of risk under a method called the Capital Asset Pricing Model, CAPM, and I believe you have done CAPM at the lower levels of financial management. The cost of capital is determined as follows. The cost of capital or required rate of return using CAPM, you'll be picking RF plus into brackets BJ into brackets ERM minus RF. Now RF means risk-free rate, then BJ, beta of the security, ERM, the expected return of the security. So note that formula that you'll be using to calculate the cost of capital or required rate of return using CAPM. You'll be picking the risk-free rate, you plus the beta factor multiplied by the risk premium. ERM minus RF gives us a risk premium. It uses different discount rates for schemes with different risk levels. It is important to note that those projects which have a normal amount of risk will not change the overall risk equanimity of the business. Therefore, it is prudent to discount them at the cost of capital. However, if an investment have a greater than normal risk, they should be discounted at a higher discount rate. The discount factors for different projects are determined then used in calculating the net present value of the specific projects based on their risk level. Under this model, the discount factors for different projects are determined, which are used in calculating the net present value of the specific projects based on their risk level. Traditionally, the same discount factor is used when evaluating different projects irrespective of the difference in their level of risks. Different projects are always affected by different factors which may not be similar to the risks of the company, hence the need to use risk-adjusted discount factors or discount factors when evaluating the risks. Advantages of risk-adjusted discount rate. 1. Simple and easy to understand. But 2, it has a great deal of innate appeal for risk-averse businessmen. And number 3, it incorporates an attitude towards uncertainty. Disadvantages. The results are not objective. Disadvantage number 2, it does not put into account that in actual sense, it is the future cash flows which are subject to risk. Number 3, it assumes that risk increases with time, which is not true. Number 4, the method assumes that investors are risk averse. However, it is not all investors who are risk averse. Investors can be risk takers or risk neutral. We move to the next page and we continue with the risk adjusted discount rate, because by the end of this discussion I will show an example through calculation. Now let's have an example. We have an example. Let's have an example. And we are told the finance manager of Bura Limited has suggested that 3 projects X, Y, and Z should be analyzed using the risk-adjusted discount rate. The finance manager has developed the following model to calculate the risk-adjusted discount rate for each project. So the formula that they are using, that they have developed, is just as it appears there. That is RF. We have said when you want to calculate the cost of equity or cost of capital, you'll be taking risk-free rate, you plus the beta factor into brackets expected market rate minus risk-free rate. You can see the abbreviations according now to this particular question, what those abbreviations are associated with. You have the risk-adjusted discount rate for the project is equals to risk-free rate, which is RF, then risk index for the project. So in their case, they will be using risk index for the project, which will represent the beta factor. Then K note, cost of capital for the company. So RF is risk-free rate of return from marketable securities like treasury bills and treasury bonds. Note that risk-free rate applies to those securities which are riskless, like treasury bills and treasury bonds. Securities which are issued by the government are riskless. They have no risk because the government does not default in payment. So risk-free rate means that the rates associated with government securities like treasury bills and treasury bonds. RM will be the expected market return. Then the beta factor there, in our case, the beta factor will be represented by RIJ, the risk index for the project. Risk-free rate for the market is 10%. Market beta is 2.5, while the expected market rate is 12%. The risk indices for projects X, Y, and Z are 1.8, 1.0, and 0.6 respectively. The initial cash outlay in brackets. So the initial capital outlay in brackets, what you mean is you can see there cash flows for X, Y, and Z. For X, 15,000. For Y, 11,000. For Z, 19,000. Those are the cash outflows because you can see they are occurring in year 0. So you're saying that the initial cash outlay in brackets and the cash inflows for the 3 projects are shown in the below table. Now that table is not appearing immediately. There was a small mistake there. The table, it is this table that we are referring to. So this table, which we are talking about, this is the table now whereby the cash flows for X is 15,000, which represents initial capital outlay, and then the cash flows now from year 1 to year 4 is 6,000 for project X, and the net present value is 2160. Then cash flows for project Y, initial capital outlay 11,000. The cash flows here are irregular: 6,000, 4,000, 5,000, 2,000. The net present value is 1674, which we will calculate. And then the cash flows for Z, initial capital outlay 19,000, then 4,000, 6,000, 8,000, 12,000. The net present value, which we will calculate, is 11.7. So that part here, whereby the statement reads that the initial cash outlay in brackets and the cash inflows for the 3 projects are shown in the below table. That table is the one that I've shown you. It could have appeared immediately after that statement, but there was a problem with the arrangement. Required the risk adjusted discount rate for each project. Number 2, net present value for each project using the risk adjusted discount rates computed above. The number 3, based on the net present values determined above, advise the company on which project to pursue. Justify your answer. Let's have the solution. Remember, what you are doing is risk adjusted discount rate. Now let's have the solution. You'll say that we first calculate the cost of equity of the entire firm using the CAPM method, and we get 15%. So basically, understand the CAPM, how to calculate the cost of equity using CAPM. We've said using CAPM, the risk adjusted discount rate will be given by RF, that is the risk-free rate, plus beta factor, then into brackets, expected market rate, you minus risk-free rate. Now see what we said here, that the risk-free rate, you see that here the risk indices will represent, these risk indices will represent the beta factor. So the beta factor for X is 1.8, the beta factor for Y is 1.0, and the beta factor for Z is 0.6. That's important thing. Now we are saying that we first calculate the cost of equity of the entire firm using the CAPM, and we get 15%. So let's see how we have calculated the cost of equity. We are saying KE is equals to 10. So what is 10? 10 is the risk-free rate. See there, we have said risk-free rate for the market is 10%. So 10 plus 2.5. 2.5 represents market beta. The market beta. 10, which is the risk-free rate, plus market beta 2.5 into brackets, expected market rate minus risk-free rate. Expected market rate is 12%, and because you'll be told that risk-free rate for the market is 10%, market beta is 2.5, while the expected market rate is 12%. So we are taking, we are calculating the cost of equity using CAPM. CAPM means Capital Asset Pricing Model. So KE is 10. 10 is a risk-free rate plus market beta 2.5 into brackets, then expected market rate or market rate minus the risk-free rate of 10, which gives us 15%. Then out of that, because we have calculated our cost of equity or our discount factor now at 15%, then the next thing to have is we have present value interest factors using 15%. The 15% that we have calculated. The 15% that we have calculated, the discount factors at 0 is just 1. At 1, 0.8697. Since we are saying 1 plus r raised to negative n. For example, for the first year, 1 plus 0.15 is 1.15 raised to negative 1. For year 2, 1 plus 15% raised to negative 2. You'll be getting now those numbers then for the discount factors. Then for x, note that the cash flows for x is 6,000 constant throughout, apart from for year 0, which represents the initial capital outlay. So you can use that calculation you see there, project X, the net present value. You are taking the annuity. The annuity in this case is 6,000, which is constant for project X. You multiply by present value annuity factor. If 15% is in your table, you can just read 15% and 4. If it is not in the table, the formula for calculating present value annuity factor is 1 minus into bracket 1 plus r raised to negative n. Our n here is negative 4 divided by r, which is 0.15. Then you minus initial capital outlay. You can see for X, for project X, the initial cost is 15,000. If you less that, you get 2130. And you can see the net present value for project X is 2130. So we have taken 6,000 times present value annual factor at 15%, 4 years minus initial cost, and you get 2130. Now for project X and for project Y and Z, the cash flows are irregular. They are not constant. So you'll be calculating present value interest factor at 15% and 4 years, and then you less the initial capital outlay. So note somewhere, write somewhere, because I'm turning on to the next page. Write these cash flows for Y: 6,000, 4,000, 5,000, and 2,000. Then initial capital outlay for Y, 11,000. Also write the cash flows for Z: initial capital outlay 19,000, the other cash flows 4,000, 6,000, 8,000, 12,000, and the net present value of 11, that's 7. So please write those cash flows for project X, Y, and Z, because I want to turn on the other page. See what we have done here. We've started by calculating cost of equity of using the capital asset pricing model, and we got 15%, and it is this 15% which we are using as our discounting factor. I go to the next page now. If you look at Y, project Y, the cash flows are there. Year 0 up to year 4. Cash flows for year 0, we have negative 11,000, then 6,000, 4,000, 5,000, 2,000. We have a column for present value interest factor at 15%. You can read from your table, the first table which is provided. You can as well calculate by taking 1 plus r raised to negative n. And then what you get there, you multiply by the cash flows to get the present values. So sum up that, and remember to minus the 11,000 because it is the initial capital outlay. So the net present value for project Y is 1673. Project Z, the same. The cash flows are different. Initial capital outlay for project Z is 19,000. The cash flows we have is 4,000. 6,000, 8,000, and 12,000. Present value interest factor at 15%. Remember 15%, we are the ones who have calculated that. And as well, so in that column, you are taking 1 plus 15% raised to negative n. Then you multiply the cash flows by the present value interest factor. You get the present values, and the net present value is 11.7 for project Z. I want to undevice now. How do you undevice that in that particular situation? How do you undevice? Now let's start by looking at cost of equity. We want to calculate risk adjusted discount rate for project X. Now instead of using using 15% here, okay, let's just use a cap M. You take risk-free rate is 10 plus. Now here, what changes is the beta factor. We have been given the beta for each of these securities. The beta for security X, we have been told, is 1.8. So 10 is the risk-free rate plus beta factor for project X, which we are told from the question is 1.8, into brackets expected market rate 15 minus 10, you get 19%. By using 19%, we can calculate now the net present value. That means instead of using 15%, you use 19%. So 6,000, remember for project X, the cash flows are annuities. So we'll be taking 6,000 times 1 minus into brackets 1 plus 19%, the one we have calculated up there, divided by rate of 0.19 minus initial capital outlay of 15,000, you get 832. So you can see what you have done here. For project X, we have used beta factor of 1.8, which you have been given to calculate cost of equity. Instead of using 15% here, we are saying we will use 19%. If we use 19%, the net present value will be 832. So net present value for project X is 832. Next, risk adjusted discount rate for project Y. The beta factor you have been told for Y is 1. So you just take 10. 10 is the risk-free rate plus beta factor, which you have been given as 1.0, into brackets 15 minus 10, you get 15%. So you can see the one that we calculated, we started with, we got 15%. Again, this one is also 15%. So the net present value will not change because in both scenarios we are using 15%. The previous one. Now if you take X, the risk adjusted discount rate for X above, we have gotten 19%. The previous one, we were using 15%. Therefore, our net present value should have been different. But for project Y, the percentages are the same. So net present value will remain the same at 1673. For Z, we are told the beta factor is 0.60, risk-free rate of 10 plus beta factor of 0.6 into brackets 15 minus 10, we get 13%. Now because 13% is not the same as 15%, we can calculate the net present value using 13%. We have here 0.24, the cash flows for project Z, 19%, 90,000, negative, that is initial capital outlay, 4,000, 6,000, 8,000, and 12,000. Then present value interest factor at 13%. The figures are there. Net present value means you'll be multiplying the cash flows by the present value interest factor at 13%, and that column you are picking 1 plus r raised to negative n. That is 1 plus 13% raised to negative n, and the net present value is 2143. Advice: the company should invest in project Z, since even after incorporating risk specific to each project, it offers the highest return. And that is the end of that discussion for today. Okay, so in case you have any question, my numbers are 0727 87 1093. My numbers are just down there in case you need assistance, in case you need any help that you may need. My numbers are there: 0727 87 1093. I'm also a publisher. I'm an author, so if you need books for accounts management, if you are taking a diploma, a degree, or professional exam, you can contact me for any assistance for either online classes or physical classes. We are based in Thika town, so if you are around Thika, you can call my number for physical classes. If you are not within Thika town, you can still have your class online at any time which is convenient. Probably you are busy working somewhere and you are not able to attend classes. We can assist you to understand some of these concepts in management. For those who are taking CASNEB examinations, CPA, that is Certified Public Accountants, those who are taking CIFA, Certified Investments and Financial Analysts, ATD, CAMS. If you need any assistance as far as your classes are concerned, just feel free to contact us through those numbers there. Remember again to subscribe to our YouTube channel so that you get updated as and when we upload these classes in our YouTube. So that is what we have discussed for today, and that was risk adjusted discount rate. The risk adjusted discount rate. Try to make a follow-up, most especially with the risk adjusted discount rate. Understand that we must calculate the required rate of return using CAPM, the capital asset pricing model. And this concept of CAPM, the capital asset pricing model, is also covered in chapter 2 of Advanced Financial Management, together with arbitrage pricing model. You can still go to our YouTube account, Fatima Institute, and you find the concept of CAPM explained there, how to calculate the cost of equity using CAPM. So with the risk-adjusted discount rate, understand how to calculate the cost of equity using CAPM. Now for advantages and disadvantages, that is pure theory, and my focus was mostly, my major focus was that part of calculation. My major focus was the calculation, and we've done that question. You can just again, you can go through that question, even though we have finished discussing it. That example there, you can start step by step. You go through that question and say that this question, where it starts here, the initial cash outlay in brackets and the cash inflows for the 3 projects are shown in the table below. Now that table refers to that. That is a table. That is a table. That is a table that we are referring to. That is a table that we are referring to, and with the respective cash flows. So just go through that question, and I think we have elaborated everything which was required of that question. We have elaborated all that which was required of that particular question. So we can leave it at that point. I believe I have assisted you to understand how to calculate risk-adjusted discount rate. Have in mind that you should first calculate the cost of equity using CAPM. So CAPM is very important as far as this particular area is concerned. So we should stop at that. I think it is well covered. Everything has been done quite well. However, in case you have any question or you need any clarification, my number is just there. Just make a call or you text me for any clarification. My name is Mr. William, Fatima Institute, Center for CIFA Studies. We meet again. Thank you for your attention.